experience in various fields related to banking and financial sector. He's even been at the helm of the Institute for Development and Research for Banking Technology. He has the first-hand experience, therefore, of infusion of technology into the banking sector. We do hope to get some perspectives, of course, from you, from that experience as well. And we know that you're very, very proactive in this space. So may I now invite you, sir, for the inaugural address, and please welcome him with a huge round of applause here. Thank you, sir.
Good morning, everybody. Sri Arun Tiwari, Chairman, Managing Director of Union Bank of India and the Deputy Chairman of Indian Bank Association, Mr. Rajesh Shah, Mr. Harley, Mr. Thakur, and friends. A very warm good morning to each one of you once again. I'm very glad that IBA, FICCI, and NASSCOM are organizing this conference as a platform for innovation and collaboration with upcoming and promising pickup, there's fintech companies. It's really great that all these institutions have joined together along with banks and fintech companies. And why it is necessary, that's what I thought I will explain a bit, because in the euphoria of the success of fintech companies around the world, there are some unrealistic prophecies which I thought we need to bring it down to earth. It's our view. Of course, people always can have a different view. Hopefully, my thoughts will set you to think and discuss and debate more about these things in times to come, including in this seminar. Technology and banking have a long, close association. Both have been benefited immensely by this association. Technological developments have been changing the way the banks and financial institutions and their customers interact. These developments have created opportunities for the new entrants, not necessarily new bankers, to disrupt traditional business models and penetrate new markets. The plethora of technological products and services have helped the emergence of fintech companies who offer different ways of doing traditional services, that too in more efficient ways. From the time the concept of money was understood, the concepts of lending and borrowing came into existence. However, the organized way of lending and borrowing happened when the prototypes of modern banks were established some 700 years ago. Banks undertook another type of service, that's the payment service. The mega trends in the fields of information and communication technology have redefined banking and banks. Actually, it is not redefinition, it is de-definition. Banking is no longer what a bank does, it is also what a non-bank does. Banks are no longer those entities which do banking exclusively. Now others, the non-banks, also do banking. Chunking of banking is a norm, and for undertaking each of these chunks, there are some specialist entities who perform only those chunks. Payment service providers, P2P services, SME financing, customer retail financing, disintermediation, crowdfunding, open-ended mutual funds, money market mutual funds, deposit alternatives, trade financing, invoice financing, bill discounters, bill collectors, credit referrals, account aggregators, interest-free products, syndicators, investment bankers, microfinance institution, cooperatives, housing finance institution, credit raters, and we can go on and on. These are all some of the entities who chipped away chunk after chunk of banking. Is there any element of banking that remains the exclusive privilege of banks? No longer. The chunking away of banking from the banks have given enormous business and growth for these non-banks. With their specialization and focused service rendering, they are able to offer the chosen service at greatest efficiency, speed, and at very affordable cost to the consumers. When these specialized entities make innovative use of information and communication technology as their business model, they tend to be called the fintech companies. There is another type of fintech companies. They are those who develop innovative systems, products, and solutions for use by those in the financial sector. They will not be in the business of offering the services themselves. These are primarily kind of R&D structure of the fintechs. I would think that these are the real fintech companies. As a definition, fintech is usually applied to the segment of the technology startup scene that is disrupting sectors such as mobile payments, money transfers, loans, fundraising, and even asset management. The term has become a buzzword in the last 3 years. It is changing the way funds are raised, used, lent, and borrowed, remitted. It is impacting not just entrepreneurs and businesses, but also the ordinary bank customers and financial customers. Not just that, the regulators across the world are sitting up and closely monitoring the developments with great interest. Standard-setting bodies like the Financial Stability Board and the Basel Committee on Banking Supervision and others who have formed special teams, working groups to examine these developments, including us. We have also formed a special team. Two of the key innovations by the fintech I want to discuss a little more. They are about the marketplace lending and the blockchain technology. Just a few seconds. Marketplace financing is also known as crowdfunding and generally refers to the method of funding a project or venture through small amounts of money raised from the large number of people, typically through a portal acting as an intermediary. There are numerous forms of crowdfunding. Some are charitable donations that provide no financial returns. Others, such as equity crowdfunding, would fall within the domain of financial markets. Person-to-person lending platform is a form of crowdfunding used to raise loans which are paid back with the interest. A lot of people around the world is seeing the end of banking and financial intermediation because of this innovative marketplace financing. Some advocate an early end to the traditional banking and financial institutions. Likewise, the blockchain technology is also another disruptive innovation. The blockchain is an incorruptible digital ledger of economic transactions that can be programmed to record not just a financial transaction, but virtually everything of value. Blockchains are an open, distributed ledger that can record transactions between two parties efficiently and in a verifiable and permanent way. Using this technology, certain innovative products which have come in the scene have excited a large section of people around the world. I am referring to the Bitcoins phenomenon. The way the Bitcoins have caught the imagination, generated interest, and gained value has led to some quarters thinking and predicting end of the currency system itself. Using the technology, certain innovative products have come in the scene, as I mentioned, and people are predicting the death of banking and even currency system. I suppose these predictions about the death of banks and financial institutions and also the currency have naturally aroused the curiosity at minimum and concerns among the regulators and central bankers around the world. Innovations admittedly bring in positive changes in efficiency, productivity, quality, competitiveness, and market share, among other factors. However, as innovations usually result in paradigm shifts, they are typically disruptive. It takes effort and time to understand them. The associated dangers include untested effects, lack of clarity on long-term effects, and can lead to misunderstanding and misusing of the innovations. Innovations can sometimes be bad per se, and sometimes even good innovation can be misused. Innovations which are by definition leveraging technology in an unusual way have the great potential to be disturbing the standard ways in which systems are operated. However, in that process, while we do gain, it is not uncommon that these innovations do inflict pains on the society. Therefore, a careful analysis of the pros and cons, a thoughtful ring-fencing of risk, closer study on pilot basis before scaling up Fine-tuning based on feedback, etc., are required before we adopt these innovations. What are the downside risks of marketplace financing and blockchain? Marketplace financing links the fundraisers and fund providers. Fine. That eliminates the need for a financial intermediary and therefore all the costs associated with. However, who guarantees the good performance of the fundraisers and fund providers? Who will enforce the contractual obligations? When each of them is faceless to one another and is at great distance, even beyond borders, the issue gets complicated. Therefore, marketplace financing may not be sustainable for a large number of people or amounts. It is a received wisdom in finance that after the initial rounds of acceptance and successes, the moment the rounds increase and more number of people get attracted in geometrical progression, the chain breaks and fails. You need an organized and a regulated entity to ensure that the innocent and weak parties are protected. Any democratic setup cannot dismiss it, quoting, consenting adult argument. Consenting adult argument cannot be presented when mass-scale failure takes place. I want to discuss a little more about the blockchain or the distributed ledger technology and its professed capabilities to usher in virtual currency. As regards the death of currency, it is not a new subject. It has been predicted right from early 1950s. As you will recall, Isaac Asimov, his robot series in 1950s to 1980s, imagined a future where cash did not exist. Instead, people earned credits that were traded electronically. In June 1991, the writers for Omni magazine claimed cash and credit will soon be obsolete. In 1994, Joel Kurtzman, in his book, titled The Death of Money, said, few people realize that money in the traditional sense has met its death or demise. Few are still paused to reflect on the implication of that. It was fashionable then to talk about the death of currency. People said by 2020, most people will have embraced and fully adopted the use of smart device swiping for purchases they make, nearly eliminating the need for currency and credit cards. Virtually all purchases will be made by handhelds, and it probably won't take 10 years to get there. These were the predictions in late 1990s and early 2000s. Has currency died? Is it dying? Or at least will it die? In all these years, you will find that currency has actually increased in absolute terms in country after country, including the West, except, of course, the Nordic countries. Countries are printing more and more currency. Perhaps, as I said, the Nordic currencies alone is the exception. Now comes the cryptocurrency. People say this time around currency will die. Some others say it will be a close call. At least currency will be replaced by virtual currency. The quest for anonymous and independent digital currency has been in the minds of researchers for quite some time. The cypherpunks, as they were called, led by Timothy May of Intel and Eric Hughes in 1992, tried to develop a privacy through crypto logic. They endorsed a mistrust on the prevalent system of currency and boasted of an anarchist philosophy to find the anonymous and independent digital currency. Wei Day, in 1998, attempted to create what was called the B-money, a money that could not be taxed or tracked. Nick Szabo attempted to create BitGold, which will be difficult to solve, that's a kind of mining, and so will have no value. He tried to create a puzzle of solving cryptographic equation which was further refined by the hands of the Satoshi Nakamoto in Bitcoins. Voila. You now have a digital currency, not created by an authority. More and more people have started accepting it. Bitcoins have acquired value. They are being used for settling varieties of economic transactions. People are using them as investment also and store of value, So currency is being eliminated. Blockchain, the foundation for Bitcoins like innovations, is touted to be the death knell of currency. I believe its potential is being overstated. We can see that in these types of solutions for virtual currency, there is no central bank or monetary authority. They pose potential financial, operational, legal, customer protection, and security-related risks. VCs, being in digital form, are stored in digital electronic media. They are prone to losses arising out of hacking, loss of password, etc., compromise of access credentials, malware attacks, etc. Payments by VCs are on a peer-to-peer basis. No established framework for recourse to customer problems, disputes, and grievances and chargebacks, etc., is feasible with this kind of framework. There is no underlying or backing of any assets for the VCs. Value seems to be the matter of appreciation, speculation. Legal status is definitely not there. While this is a purported objective of a VC, it puts a natural limit for its progression. I will explain a bit in a moment. And finally, the usage of VCs for illicit and illegal activities has been reported, and it is becoming uncomfortably large. My arguments against the virtual currencies stem from two key elements. They are the concept of confidence and anonymity. A currency should be able to sustain these two elements forever. It will impair its exalted status once either one of these elements gets affected. The confidence in Bitcoins, or for that matter, any virtual currency based on blockchain or any other technology, is also limited to its initial rounds and initial circles only. The initial rounds are always filled with adventurists and risk seekers. The moment masses gets in, that the risk avoiders gets in, they will need greater confidence for its acceptance and continuance. And they can come only if an authority endorses it. As regards anonymity, the blockchain technology apologists say that it can be made very difficult to track. They say difficult to track, and not anonymity, which a currency offers. Therefore, it may remain a pipe dream that blockchain will eliminate currency by ushering in virtual currency. It is unlikely. These are some realization among the proponents of these fintech innovations. They do see over-imagination of capabilities of fintech innovation, and it can be bad for further developments in that area. In parallel thinking, the banks and financial institutions have also realized that there will be value in adopting fintech or adapting it for their own mutual benefit and for the benefit of the customers. There is a movement to make use of blockchain technology for virtual currency by the central banks themselves. Of course, this calls for a lot of research. I am glad that IDRBT brought out a white paper on applications of blockchain technology recently for the banking and financial sectors. There are several such endeavors in the world. Hopefully, these will lead to usable solutions. To conclude, fintech companies are accelerating the pace of change and are reshaping the financial services industry. Financial service providers like banks are recognizing the potentials of the fintech. It is clear that the disruptive innovations of the fintech cannot wholly eliminate or completely decimate the traditional banking or finance. However, I can see that there are immense ways in which the fintechs and bank and financial institutions can collaborate with one another to usher in the best value for the financial service customers. I am sure that this conference will provide the unique platform to all the stakeholders for creating a potential set of opportunities for meeting grounds and build mutually benefiting partnerships. Thank you very much for your attention.